With us, Jim Copland. He is director and a senior fellow at the Center for Legal Policy at Manhattan Institute for Policy Research, and John Hummel from AIS. John, just to kind of kick off the back and forth, you're an investor. You decide what stocks you might want to buy and what you might not want to buy. Does it matter to you what the corporate activism has been like on a particular company?
Well, we always start out trying to identify what we think is unique and different about a particular cycle that we're in, and whether or not the market has discounted those factors. So if an activist is involved in an area that we're involved in, we'll pay attention. Otherwise, we're avoiding it. I mean, our view is that it's the developing world that's driving world growth, and then the...
But for example, I think of Kraft, right, which was a company that had two very major divisions that were then eventually split into Mondelez and Kraft. Would that be the kind of business, if it met your other criteria? I mean, does that kind of activism and action make a
sure.
difference?
I mean, we think activism is very valuable in terms of forcing management to consider shareholder value.
Jim Copland, activism and the boardroom, right? This is a key thing that managers have to think about.
Absolutely, and I think it's been an increasing thing in recent years. They've had to think about it.
Proxy fights, right?
Proxy fights, and even beyond traditional proxy fights. So we all think about the sort of takeover activism in the 1980s, the barbarians at the gate, and I would tend to agree that that type of activism tends to add value. But you also see a couple of other types of activism. One are these activist investors like Mr. Icahn and Mr. Ackman that are going after companies to try to change their performance without necessarily getting involved in a traditional proxy fight. And some of the rules have changed to facilitate that. You've seen a trend to declassifying boards of directors, so all the directors are elected annually, requirements that directors get a majority vote, and then most recently around 2010, you saw the New York Stock Exchange, under some pressure from the SEC, changing its rules such that brokers couldn't vote the shares of folks on
they had a
director
fiduciary role in, and then they couldn't then go ahead and vote the shares on behalf of the actual shareholder.
Absolutely. So that empowers institutional investors. It empowers proxy advisory firms like ISS. And so what that's done is really changed the ball game. And we've also seen an uptick in this sort of social or policy type shareholder activism that we've been tracking at the Manhattan Institute's Proxy Monitor Project. And in fact, in 2012, if you look at all the shareholder proposals that were introduced, 41% of them involved social or policy goals that went beyond things that are clearly connected to share value, like corporate governance rules or executive compensation.
Has that was something that you find in your research work, that the companies that do best are also the companies that want to do the best in terms of how they operate and how they treat their employees and their customers?
Absolutely. Companies that pay attention to shareholder value are really the ones that I think perform the best over time, and that's definitely where you should have your money.
Is that one of the sort of touch points now because of the debate having to do with companies that have a lot of cash that may be outside the United States in foreign subsidiaries, and they try to think about ways to bring it back to the U.S. and not change the shareholder value?
Well, they don't necessarily have to bring the cash back here. I mean, there's plenty of investment opportunities overseas, so I think
mergers and acquisitions, for example.
Yes, yes. I mean, one of the things that they don't look at, though, are the statistics on how much debt has increased for corporations, which has actually increased more than cash. So companies are not quite as liquid as just looking at the cash numbers.
Jim, I want to bring up a point that maybe John was sort of alluding to there. The idea that when you have all this cash that exists, it's not the cash of the company, it's the cash of the shareholders. And the board of directors is legally bound to look out for the shareholders.
Absolutely.
So would you expect in a case like Herbalife for the board to come out with some statement, or, I mean, why would this drag on for such a long period of time?
Boards and management have to be very careful. Any statement they make can trigger lawsuits, they can trigger SEC investigations, so they're going to be very, very careful in what they say. That's sort of the litigation and regulatory climate they're acting under. I mean, there's no question that if you're sitting on a lot of cash, it's a logical question for shareholders to say, what could we do with that cash? Ultimately, the shareholders have ownership over the residual value of the company, and sitting on cash may not be the right strategy. On the other other hand, management's actively going to be looking at these sorts of questions, and we don't know what sorts of plans they have from the outside looking in for their cash in all these cases.
I want to thank you, gentlemen, very much for joining us. John Hummel joining us from AIS Capital, and I want to thank Jim Copland. He is from the Manhattan Institute for Policy Research. Much